reversal taking place in risk assets. So let's go through exactly what happened, why this is happening, and then finally how we are adjusting accordingly. First off, why? Well, let me begin with this crazy headline over at Zero Hedge. U.S. employment unexpectedly defies expectations and rises by 336,000 jobs in September. This is completely insane. The market was expecting a drop of 100,000 jobs. They've got a gain of 300,000 jobs. And when we look at this chart right here, which includes revisions for the prior 2 months, we can see that there is an upwards trend. And if we zoom out a bit, we can see just how strong the labor market really is. There are more people working today than before the pandemic. The unemployment rate is near historic lows. When we look at initial claims, it's actually risen quite significantly in the last month. But even still, we're still at extremely low levels, suggesting that layoffs are not picking up across the country. Now, this should be bad news because the Fed is trying to cool down the economy in order to bring inflation back down to 2%. But fallen interest rates have opened up a lot of space for leverage to come into the markets. Falling rates means that borrowing is cheaper. It means that companies can refinance their debt at lower rates. Consumers can take out mortgages or order loans or personal loans at lower rates. It means that banks can make more money by lending out cash without having to worry about the same kind of return requirements they would have had in a higher interest rate environment. If we look at the smartest measure of interest rates, the 10-year Treasury yield less the 2-year Treasury yield, we can see that it has fallen dramatically since the Fed started cutting rates. And if we look at the change in net bank credit, which basically measures how much banks are willing to lend out, we can see that it has gone straight up since the Fed started cutting rates. And all that extra credit creation is flowing directly into the stock market. In fact, we can see that margin debt hit a new record high in August. Margin debt is simply when people borrow money to buy stocks. If we look at this ratio between margin debt and total equity, we can see that it is also at a new record high. In other words, people are borrowing at record levels to buy stocks. Of course, this isn't anything to worry about until something goes wrong and people need to sell. That said, leverage is flowing into the stock market. And when we look at where this money is going, it's interesting. In our most recent newsletter, we talked about how retail investors were flocking towards clean energy stocks, which makes sense given that there's a ton of hype surrounding this space right now, but also a huge amount of capital flowing in. In fact, solar and fuel cell stocks have seen almost 4 times the buying compared to the selling. And that is one of the reasons why so many of these stocks have rallied so hard this year. But it's not just clean energy stocks seeing this type of buying pressure. We can see a similar thing happening with artificial intelligence stocks. Basically, any stock with AI in the ticker symbol has seen record buying. In fact, the buy-in for AI stocks is 17 times higher than the selling. And if we look at small cap stocks in general, we can see that they're seeing the most amount of buying ever. Of course, it's possible that this is just retail investors piling into the latest hyped up sector, but there may be another reason why so much money is going into these spaces. And that's because hedge funds have been dumping them. For example, in the first half of this year, hedge funds sold a whopping $9.8 billion worth of clean energy stocks. Now, sure, it's true that a lot of those stocks have rallied since then, so those hedge funds that did sell may be kicking themselves right now. But nonetheless, hedge funds have been net sellers of clean energy stocks for multiple quarters now. At the same time, we can see that hedge funds have been dumping small caps for the last few quarters as well. This could simply be because hedge funds are generally long-term investors who believe large cap stocks are better for long-term growth. But it could also be that they're getting crowded out by all the leverage coming into these smaller stocks. That's why it's really interesting to see that the best performing sectors this year are small caps, clean energy and AI. These are all areas where retail investors have been piling in while hedge funds have been getting out. It's almost like the little guys beating out the big institutions. And here's a brief testimonial from one of our members. Hey, just wanted to say thank you. I used my knowledge from your service to avoid investing in stocks when you recommended doing so. Then when you said it was time to buy, I jumped in with both feet. This past week I made $30K in options. Thank you again. And here's another one from a different member. Just wanted to send a quick note to tell you that I bought the dip last Friday as you suggested. I went heavy on Monday and did great. Thanks for being right again. Here's one more and then I'll stop. I love this community. When I joined 2 weeks ago, I didn't think it was for me, but the chat room is awesome and the calls are phenomenal. You guys are the real deal. Now, of course, these are only short-term wins. The market doesn't go up every single day. Even though we are seeing some very strong fundamentals for certain sectors, there will always be another hyped-up narrative that comes along and sucks money away from those sectors, putting them out of favor for a while. The point is that retail investors have to be very careful that they don't get caught up in the next hot stock or the next hot sector just because it seems like fun. Sure, it might go up 100 or 200%, but that doesn't mean that it's not already priced to perfection. Instead, we want to look for stocks that have strong fundamentals, strong cash flows, strong balance sheets, and aren't trading at absurd valuations. Once we find those stocks, we can then wait for a pullback and buy them on the dip. And that brings us to our final piece of evidence. which is that stock valuations are beginning to rise again. Just a few months ago, stocks were trading at rock-bottom valuations. But now, just like interest rates, they're beginning to head back up. This rising interest rate environment hasn't been good for stocks because it means that future cash flows are worth less today. Higher discount rates mean lower present values. But now that rates are falling, present values are increasing, making stocks more attractive. What this means for us is that we should begin looking for opportunities in stocks that have strong fundamentals, but that have also been beaten down. One such area is financials. As you can see, the sector has been in a downtrend since the start of the year, largely because it's very sensitive to interest rates. Higher interest rates mean more net interest income for banks, but the problem is that when interest rates rise too quickly, it leads to a recession, which means loan defaults go up, and that hurts banks. In other words, banks thrive in a higher for longer interest rate environment, but they don't do so well when interest rates rise too quickly and cause a recession. Well, now we're in a weird situation where interest rates are falling, but the banking crisis in Europe isn't going away. For example, we just got this headline from Bloomberg yesterday. Deutsche Bank plunges after posting surprise third-quarter loss. The German lender set aside billions to cover expected loan losses tied to its shipping and Russian exposures. Now, to be fair, this isn't really all that surprising. Deutsche Bank has been on the brink of collapse for what feels like a decade now. But the point is that financials are still in a period of turmoil. No one knows how bad things will get in Europe or even in the US. So now is probably a very good time to begin finding opportunities within the financial sector. One such opportunity may be regional banks. When we look at the KBW Regional Banking Index, we can see that it has declined almost 30% year to date. A lot of this has to do with higher interest rates hurting net interest margins for these banks. But also, there was a ton of fear that regional banks were going to implode, like Silicon Valley Bank or First Republic. Now, we obviously don't know how bad things will get with regional banks, but we can see that the market is pricing in a massive amount of pessimism right now. A simple way to play this would be to buy the KB Regional Banking ETF. Another way to play this would be to buy shares of a regional bank that looks fundamentally strong. I personally like Key. Not only does it pass my eyeball test, but it also has a strong balance sheet with a high amount of liquid assets. Of course, this is to say that every regional bank is strong because we know that that's not the case. But this is simply one example of a stock that we could buy if we believe regional banks are poised to survive this next period of stress. And that's just one example. Another example would be financials in general. As you can see, the sector's down almost 20% year to date. And one ETF we could buy to play this would be Financial Select Sector Spider Fund. This fund holds some of the biggest and strongest financial stocks in America. So if you want to gain exposure to financials, this would be a very easy way to do it. The point is that stocks have begun to rally again, and that's because interest rates have fallen. Lower rates mean that borrowing is cheaper. That means more money flows into the stock market. It also tends to push money away from hypergrowth stocks and into value stocks. What this means for us is that we need to be on the lookout for stocks that have strong fundamentals, but that have also been beaten down. Financials and energy are two sectors that fit this description, and there are many opportunities within those sectors. Now we just need to figure out which ones are strong enough to withstand this next period of turbulence.